of Equity Compensation. My name is Mike Blake, and I'm president of Arpeggio Advisors, a boutique business appraisal and strategic advisory firm headquartered in Atlanta. So before we begin, let's all agree that whoever's watching this is watching this of their own accord, and this is on the internet after all, so beware of anything that you hear or see on the internet. Your mileage may vary, and before you take any meaningful decision, make sure that you're consulting relevant advisors, especially legal counsel. And I will leave this up here for another few seconds just so you can fully read all the disclaimers, and if you don't agree with them, then please feel free to tune away. Okay, so if you're still here, welcome back, and thank you for listening. I think this will be a pretty good educational topic. So the goal here is to provide an understanding as to equity compensation, how to grant it, how to receive it, how to negotiate it. And the genesis of this discussion is based on the fact that I am asked the question all the time. It's perhaps the question I'm asked most frequently. I've got somebody that I want to hire, or I'm thinking of taking this job and they're offering me stock or stock options or phantom stock. How much should I ask for? And just as with most meaningful questions, there's no one simple answer. But I do think that I can provide a framework for figuring out how to get to that answer on your own, and I can also show or offer some illustrations and some data points in terms of how others have approached that question, as well as providing some benchmarks. So why do we care about stock grants? Well, it's a really important decision. It's often a multi-million-dollar decision, especially if you're the grantor, but maybe the grantee as well. If that company does well enough, even a relatively small grant can be worth an awful lot of money. And we care because the answer is not obvious. There's no formula out there per se that tells you how much you should offer to employees or how much you might want to take as an employee. It's not something that's talked about a lot. It's not something that's even written about a lot, although it's written about a little bit, and there is some data out there. And as I mentioned before, among startups anyway, this is the most frequent question that I'm asked, and that's what's motivated me to do this webinar, so that I hope I can answer this question more or less one time, and then if people have specific questions, you're more than welcome to contact me. So let's take a look at why do we offer equity compensation. As business owners and managers, why do we do it? Well, we're trying to incentivize value building, and this is in contrast to incentivizing growth or profits or some other metric, because growth is fine as far as it goes, but it's not necessarily what builds value. It's not necessarily what makes managers look better. It's not necessarily what makes the shareholders of the company wealthier. Same with profitability. Now, of course, everything else held constant, we'd rather have a more profitable company than a less profitable company. But there are many instances where the market values things other than short-term profit. And in addition, it's worth pointing out that there's a lot of concern in the market today about providing incentives that are based purely on accounting metrics, because A, they may not capture what you really want to have happen, and number two, they may encourage short-term manipulation, right? You may do things to make your numbers look better this quarter at the expense of performance in the following quarters, in effect robbing Peter to pay Paul. But because as human beings we tend to be short-term thinkers, it's hard to delay gratification. If we're given an opportunity to generate bonuses for ourselves right now, we'll do that, and we tend to worry about later. We also offer equity compensation because we believe that it helps us retain top talent. If you're an owner of a company, you're more likely to stay and not as likely to look to move elsewhere, at least so the theory goes. And finally, it's a cash saving tool. Although equity compensation can be the most expensive way to pay somebody for their expertise and services. Maybe it's all you got, because there are lots of things you can't pay for with equity compensation. You can't buy a laser printer with a stock certificate. You generally can't pay rent with a stock certificate. You can't pay taxes with a stock certificate. So you have to save that cash, because cash is the universal currency of exchange. To the extent that you can buy or acquire much needed resources with a currency other than cash, that can be very attractive. Now, as an employee, why would you accept equity compensation? Well, maybe you really want the job, but you realize the employer they can't pay you what you need to be paid. And so if you want to take that job, you got to compromise and take some of your pay in stock or some stock-like security. It obviously helps if you can afford it if it doesn't pan out. In other words, if you're being offered half your market rate in cash, and you are being offered sort of the other half to fill that gap in stock, there's no guarantee that stock will be worth as much as promised or even anything. So it's important that you can afford to take that loss, because when you accept equity compensation, you become an investor. And so you need to think about, can I afford to live without that liquidity, irrespective of whether I think that it's a good investment or not. And finally, of course, it helps if you are confident that the stock is going to do well. Equity compensation is a lot more attractive when it's a high-flying stock. It looks like it might be the next unicorn, going to go IPO, will be bought, whatever the scenario is. Having a lot of confidence the stock will appreciate in value will make you, of course, much more enthusiastic about accepting stock in the place of pure cash compensation. And equity is often used to pay at least 5 groups of people and resources, and maybe more, but these are the 5 that immediately come to my mind. So it would include board members, lenders in the form of warrants, executives, finders, people who go out and find capital for you, as well as professional advisors. All of them, at one time or another, may accept or even ask to be compensated in the form of stock compensation. So let's start with, let's move on to understanding the various forms of equity compensation that might take. And the most obvious and at least seemingly straightforward form of compensation is a direct stock grant. And employees like stock, makes them feel like it's an ownership stake. You have more rights as a stockholder generally than you have as an option holder. You're entitled to dividends and so forth. So offering stock, at least in the short term, tends to make employees fairly happy. The downside is that offering stock can make the recipients and the grantors unhappy. There's, of course, the matter of taxation. If you give somebody shares, those shares may be classified as current compensation. So you're saddling the recipient with a cash tax bill on a non-cash compensation. That can be problematic. Issuing stock grants to people other than those who are buying the shares and investing in the company means more dilution, a lot more sharing to go on. Stock grants are expensive to administer and to execute. You may need an appraisal of those stocks if your employee wants, or you may need it for yourself if you are considering making an 83B election and trying to figure out which you should be doing. Do you want to be taxed now on the value of the stock, or do you want to be taxed later on the capital gains? And finally, stock grants aren't necessarily the retention tool that we think it is, depending, of course, on the buy-sell provisions, forfeiture provisions, and so forth. But it turns out that the mere issuing of stock to employees or others really hasn't proven to be a strong driver of retention. So you go through all that, it's not even having the desired effect. Now, in contrast to stock, there are also stock options and stock appreciation rights. Stock options simply represent the opportunity to buy shares at some future point in time at a fixed price. And usually that's set up with the goal that it will give employees an opportunity to buy stock cheaper than anybody else could. And if they wanted to, they could turn around and flip the stock and make a profit. So the goal is to incentivize your employees or incentivize your board members or advisors to assist the company in increasing its value to the point where it is profitable to exercise the options. There's also a concept called stock appreciation rights, which I consider to be very similar to phantom stock. There are, in fact, some nuanced legal differences, but for purposes of this discussion, we're going to assume they act the same, or at least the same enough to be lumped into the same group. And with stock appreciation rights, employees are given cash or perhaps even shares based on the increase in the stocks or the company's value between the grant day and the future. So if the company's worth $1 million today and it increases to $2 million tomorrow, that appreciation would lead to some form of bonus or participation for any individuals that were involved or associated with that stock appreciation rights plan. So stock options still tend to make for pretty happy employees, perhaps not as happy as owning stock outright. And I have known cases where employees had a strong preference for owning stock, and sometimes that worked out and sometimes it didn't. But stock options are certainly better than offering nothing. And the good news is that stock options tend to be much more tax-friendly than issuing stock itself, because it's fairly easy to set the stock option plan up in such a way that the grants will automatically be considered deferred compensation. And instead of having to do an appraisal for an 83B election, you'll have to do an appraisal for a Section 409A stock option grant, which tends to be a little bit less involved. Now, the downside of stock options is that you don't know if those options will ever be worth anything, right? They're not the same as stock. They're not sort of the gold standard. So there's every possibility that the stock options may be worth very little or indeed worth less, depending on how well the company does and depending on where the exercise price of the options is positioned relative to the value of the underlying stock. And although I think that granting stock options is perhaps less expensive than granting stock outright, there are still expenses, namely the aforementioned Section 409A stock option appraisal exercise. Now, stock appreciation rights or phantom stock represent the most minimal commitment on the part of the company or the employer, if you will, in terms of giving employees or others a piece of the success of the company that isn't simply directly tied to an accounting metric. So the commitment by the issuer is fairly low. But the downside is that stock appreciation rights are complicated. Sometimes they aren't even sufficiently transparent. And so stock appreciation rights or phantom stock often lead to confused employees that don't understand the value of what they're being given. I think in many cases they underestimate it. And so it doesn't necessarily have the desired effect, at least not right away, unless you provide a good deal of education to the people that are supposed to receive these stock appreciation rights or SARs / phantom stock. And stock appreciation rights will have a fair amount of bureaucratic burden because you're going to be measuring the value of the associated stock not just once, but probably once a year. You have a lot of calculating to do to figure out what the bonus is or what the stock appreciation right provides in terms of economic benefit to the holders. So while there's less commitment to the issuer, stock appreciation rights are the more complicated of these three methods of offering equity compensation. Now, at the end of the day, trying to figure out or trying to determine the appropriate amount of equity to offer or to receive in a particular discussion really just comes down to math. And the math question really is a valuation question. And I'll show you why. Step one is to figure out what is the typical or desired total compensation. In other words, how much would that employee receive in the market on average, and in an ideal world, assuming that you could afford to pay that. And then step two, how much can you afford to pay in cash? And step three, what is the gap between the two? What is the gap between a target compensation level and the amount that you can or are willing to offer in cash? Step four is, what is the value now per share or option being valued? So we need to start to put apples to apples here. And then step five, how many shares or options are going to fill that gap? So we have a gap of compensation. We know what the number, we know what the value of shares is, or we think we know somehow. We're not going to get into that a whole lot. And then it's simply a fairly simple arithmetic discussion. How many shares or options will it take to fill that gap? So here's a hard example. Let's say that a CFO is being recruited for a company and her total compensation would be $180,000 in the open market. And the company is able to budget $150,000 in cash for that role. There's a $30,000 gap, 180 minus 150. So to meet those compensation requirements, right, unless you can somehow just sweet talk that person to taking the CFO job for less, $30,000 in value of something is required. And let's say the company and the CFO come to an agreement that they both think their stock is worth $1 a share. And thus we need 30,000 shares to bridge that $30,000 gap. And in this happy scenario, the CFO is retained at a base compensation of $150,000 in cash and $300,000 in base shares, or in just shares. So if the question of granting stock or options is a value question, does that mean you're going to have to do a business valuation? The answer is probably. If you issue options, it's going to be required by the IRS. If the recipient makes an 83B election and they choose to be taxed on the current value of the shares, then an appraisal will have to be performed and submitted to the IRS as well. And it's probably going to be required to set the baseline for stock appreciation rights programs and to measure changes in company value over time so that the payouts can be calculated on those stock appreciation rights. Now, another important feature of equity grants is vesting, right? More and more frequently, it is the case that shares are not granted all at once, but rather a group or pile of shares or options, usually shares if they're vested, is going to become available over time, and usually gradually. Usually it works out that maybe after a year some shares are available, maybe after 2 years more shares, 3 years more shares, and so forth. And the assets will vest based on the longevity of the employee. Now the downside for the employee, or for the recipient for that matter, is the longer you have to wait for the vesting to take place, the less those assets are worth. And here's some examples of how we might make adjustments to value based on vesting features. Vesting discounts are really a function of time and risk. The longer you have to wait to receive your shares, the more heavily they'll be discounted. And the more risky the shares and the company that has issued them is perceived to be, the more those vesting periods will lead to a higher discount. And so the way that I've computed these vesting discounts is to use what's called a protective put option model, relying on the Black-Scholes technique. So Black-Scholes is one of the oldest, if not the oldest and most established option pricing methodology. And a protective put is simply intended to compute the following. How much would I have to pay in order to lock in this current price for me to sell at that price at some point in the future? In this case, 1 year, 2 years, 3 years, and 5 years. And one of the key drivers of that discount is time, right, as we discussed, but also the riskiest, the risk factor associated with the company. If the company is relatively young and high risk, then we're going to be a little afraid that maybe 2, 3, 5 years will never come, and that stock or those options may just flat out go away. And so we need to capture both that time element and the risk element. So let's look at an example. Let's say 10,000 shares are granted with a value of $10 each, and the grantor is a high-risk company. The shares vest in 3 years. We'll assume that the shares do not grow in value at all. It's a flat zero growth scenario. Our nominal value for all the shares is $100,000. Excuse me. And our vesting discount, if you remember the table previously, for a 3-year high-risk company is 53%, which means the value of these shares with the vesting feature is only $47,000. So here it's clear that vesting leads to lower value being transferred. Now, that doesn't mean you shouldn't accept shares that have a vesting feature. In fact, few companies will not require some sort of vesting feature. But what you may want to do if you're a recipient is you may want to use this argument to ask for more options so that or more shares, so that when the vesting occurs, you wind up being effectively made whole. Now, valuing stock options can be fairly tricky. If you want to try it yourself, here's the formula. But you don't need to do it that way. Instead, you can use an online calculator, such as the one illustrated on this slide. And one of the key things that I'll point out here, if you look on the right-hand side, the stock price and the exercise price are identical. That's the key. It doesn't really matter what the stock price and exercise prices are. When we calculate the value of an option, what we really care about is what is the difference between the strike price and the stock price, not their absolute level, and how far they are away from zero. So in this case, we have an exercise price and a stock price that are equal. That's called an at-the-money option, and it's very typical to issue options this way. And I think it is also appropriate to compute a vesting discount this way, because all we're trying to do is, again, lock in the value that we're being promised today to be delivered at some point in the future. Now, you can look some of these variables up, but I'm going to give you some rules of thumb you can use, so you can just plug these numbers in and run this own calculator for yourself. So the stock price and the exercise price should equal one another. The time to maturity should equal the time until expiration, or the expected holding period. Now, the expected holding period may be the period until the expected exit of the company. So maybe that's the time to maturity. More likely, it is simply going to be the vesting period that you are forced to observe because you've received vested shares. And we'll say our risk-free rate is 1/2 of 1%. You can quibble with that, but that's a fairly good number across a number of variables in a calculation like this. And then we have to put in this annualized volatility that you'll see towards the bottom of the Black-Scholes calculator page. And one can go out and simply compute the volatilities of guideline public companies and then apply them to our subject company. But that's beyond the scope of this particular educational exercise. I'm not going to teach you how to do that. You don't need to know how to do it. I can tell you that if you think it's a low-risk company, a volatility of 30% is just fine. And if it's medium risk, a volatility of 50% is just fine. If it's high risk, then 80% or higher is just fine. Now, could you quibble? Sure. Will the markets change? Yes. But if you're not a financial expert and you don't want to kind of roll your own Black-Scholes models, these are inputs that are going to be good enough for your purposes. They will get you close enough to the right answer to enable you to make a good decision. Now, I promised also that I would share with you some rules of thumb. So these rules of thumb are ones that have been published in various sources as listed below. And as you can see, those sources are all pretty credible. So while I wouldn't consider these market comps per se, the fact that these individuals think that these ranges are appropriate, I think gives some credibility. So a decent rule of thumb for employee stock option pools is to reserve 10 to 20% of the common stock for the company, or for the employees, sorry. Normal, what I might call normal or garden variety advisors, might command 1/10 of 1% to 1/4 of 1% for their efforts on behalf of the company. Now that number could increase if it's very high risk, high maintenance of loss. Super advisors or board members tend to be paid more, and super advisors and board members are thought to be individuals that have the wherewithal and capacity to recruit new investors, new key hires, or find new customers. And thus, the rule of thumb out there seems to be 1 to 2% of equity, or up to 50% more if the company is very young. VP and director level employees appear to command 1 to 2% as well. I think it's probably closer to 2, but that's just a gut feeling. In any event, founders are hoping that they have 20% of their original equity left at the time of the exit. So be mindful of what the business owner may be trying to do. Non-founder CEOs often get a 5 to 10% grant of the company's stock. Other C-level executives command 2 to 5%. Managers 0.2 to 0.3%, and engineers between 0.2 and 0.7%. So there's a wide range, but of course the range is dependent upon seniority, expertise, so forth. Now the Founder Institute also suggests this schedule of stock grants, or stock option grants, if you will. And this chart shows on the horizontal axis what is the development stage of the company, and then vertically is how active is that advisor in the company, right? If it's somebody that just sort of comes to the monthly meetings but doesn't really contribute a whole lot before that, you're not going to get as much stock as somebody who's going out and trying to find customers. And that's fair. In addition, the less developed the idea is, the more stock you're going to have to give to make it the director's time worthwhile in being involved in the company. So you can see how this matrix works here. If you just sort of just show up and attend monthly meetings and actively participate, if it's a high growth, high risk company, the going rate appears to be about 1/4 of 1% of the equity, and then growth stage is what growth stage is here. So with that background, here's some tips for how to issue equity well. First, if you're a grantor, if at all possible, your equity should vest. Especially if it's shares as opposed to options, because we don't make perfect hires, and you don't want to give stock to somebody that is a potential mistaken hire, because once somebody gets stock, it's really hard to get them out, extremely hard. You should get some idea on the fair value of the shares or options being issued. You could hire somebody like me, you could hire somebody else in the marketplace, or maybe you just talk to some people about kind of going rates, that's fine. But you need to have some idea. If you don't have some view on the fair value of your shares, it's going to be really hard to match up an appropriate level of equity compensation to match the gap between that and the cash. And also tie grants to performance wherever possible, and even structure takeaways. If an employee underperforms, maybe they even lose stock. Nothing wrong with that. Now, if you're on the accepting side, make sure you get the agreement in writing. I've seen too many cases where employees have walked into a situation, they're promised stock by founders, and there's delay after delay after delay, and then at some point it just never shows up. Stock just never comes. So make sure you get that in writing. People have short memories. And again, if you're going to accept equity, you should know the value of what you're accepting. Unless you have no leverage and you have to take the job, at which point it doesn't matter. But it's important, once you accept equity in lieu of cash, you're becoming an investor. So you have a right to understand what the value might be. And make sure you're understanding future capital raising plans, because that could very easily lead to sharp dilution of your interest. So to wrap up, I'd like to leave you with the following thoughts. One is that shares are overrated as compensation. They make employees feel good, but stock options by and large have the same upside, and they're far less time and money consuming to grant. The equity grant question is largely a valuation question. I hope that I've illustrated for you today that the solution to how much equity should I grant really boils down to, well, how much do you want to grant, right? And what is the value of that? Are you inadvertently underpaying or overpaying somebody? And then make sure you discuss who's going to pay for the compliance and reporting costs. So if you have an employee or maybe a finder who comes on and they want stock options, okay, fine. But if you haven't issued stock options before, this is going to be a brand new expense for you, because you have to have this 409A appraisal done, or at least very strongly should have that 409A appraisal done. So who's going to pay for it? Is it going to be you? Is it going to be the recipient, or maybe some combination of the two? So with that, I will stop it here. There's more detail we could always go into, but I wanted to make this as painless as possible, make it fairly brief, and therefore at least give you food for thought and the ability to go learn more on your own if that's something that you think is important to you. And of course, I would encourage any listener to call me at the phone number below or email me at the email below. Happy to answer questions anytime that I can. So thanks very much for listening.